Hi guys, in this video we're going to do chapter 18, which is a Keynesian model, Keynesian models including the government and the foreign sector. So we are continuing with the Keynesian model. It's just that now in this chapter we're going to be building up the Keynesian model. So we're gonna be adding more component into the Keynesian model. So the learning outcomes, once you have studied this chapter, you should be able to explain, should be able to explain how government spending, which is denoted by G, affect the level of production and income. Must be able to describe how the introduction of proportional income tax affect the multiplier. Must be able to use the simple Keynesian model to analyze the effect of fiscal policy. Must be able to explain how export X and import Z affect the level of income in the domestic economy. Then you must be able to also analyze the effect of changes in government spending in the economy. Right. So part one, we're going to be looking at the closed economy with the government sector, right? So a closed economy is an economy that only consists of the households, the firms, and the government sector. And the open economy, that is where now we open our economy to the rest of the world, right? That is where we also have what the foreign sector. So in the open economy, we have our firms, households, the government, and the foreign sector. And in the closed economy, it only has the firms, the households, and the government sector. Right. So we're going to be for the first part, which is part one, we're just going to be looking at a closed economy that is also called the three sector model. So you remember that in the previous video, the last video that I posted, we are looking at the simple Keynesian model, right? That was basically like just an introduction. In that video, we were introduced to this economist who is John Maynard Keynes, right? And then we said that he developed an idea that total production and income in the economy is determined by total spending or demand, right? He developed the idea. And then to further now explain his idea, he then came up with the Keynesian model, right? And in that video, chapter 17, we're basically looking at the simple Keynesian model, right? Where now we said team in a simple Keynesian model, we only have two sources of spending, which are just the households and the firms, right? And we also made these assumptions to say that we're going to also assume that in this economy, we only have two sources of spending, right? Which is the households and the firms. And also said we're going to assume that prices are given, also that the money supply is given, and also that the interest rate is given, and that demand drives economic activities, right? We made those assumptions. So we are not going to be calculating inflation and we're going to be focusing on the prices and all of that, but we're just going to be focusing on that simple Keynesian model to try and um work on this idea that Keynes came up with that total production and income is determined by what? By total production. Sorry, by total spending or demand in the economy. Right. So for this video here, we are going to be building up from from that model, right? We are adding more component to the model, more sources of spending. In that video, we only had two, which is the firms in the household, right? And then we said that that is called a two-sector model or a simple Keynesian model, right? So now here we're going to be adding another source of spending, which is the government expenditure, right? Or government spending. Right. And then that one now becomes a three-sector model or a closed economy. And then further in along this video, towards the end, we're going to add another source of spending, which is now the foreign sector. Right. And then if now we open our economy to the foreign sector, it then becomes an open economy because now we are able to interact with the rest of the world, right, via export and import. So that one then becomes a four-sector model simply because it consists of four sectors of sources of spending, which is going to be the households, the firms, and then because in this one we are going to add the government, in that in the other one that we're going to do, the last one, we will add the foreign sector, which will then we at the end at that point we'll be having a four sector model, right? Okay, so ish, I just hope I didn't confuse anyone with just because I was just trying to just give you guys some information so that you understand what is happening now. So now what we are going to be focusing on right now, we're still looking at the assumptions are still the same. It's still the Keynesian model. It's just that now we are adding another source of spending, which is the government expenditure, right? But everything that we were doing in the previous video, it still remains. The multiplier is still the multiplier. The consumption function is still the consumption function. Aggregate expenditure will still have that, and so on. It's just that we're going to add the government spending, and it also comes also with its own components rather, right? So let's just start. So introduction, they're saying here we introduce government and the foreign sector into the simple macroeconomic or Keynesian model. We consider government spending, taxation, taxes, export, import, implications. There are more elements in the model and more leakages from circular flow of income and spending. The multiplier becomes smaller. So as we're going to be adding more components, there are going to be more leakages. And also the multiplier will become what? Smaller. And also as we're adding more components, it's also going to affect our aggregate expenditure or income, right? Remember, aggregate expenditure is, wait, I'm looking for yeah. Aggregate expenditure is this one. So, so far you just know that to calculate your aggregate expenditure, which is equal to income, which is equal to GDP also, you just say C plus I, right? Because this is what you know. This is what we've been doing in that previous video, right? The simple Keynesian model, right? But now we're going to be adding another component here, which is G, right? For government spending or government expenditure, right? Remember this one, we said it was autonomous, right? So obviously aggregate expenditure and income also changes as we're adding more components, right? But you're going to see this. And the multiplier becomes smaller, right? You must remember the multiplier. We said that the multiplier, it measures how much income is generated by an increase in investment or in spending, right? How much income, it measures how much income is generated, right, by an increase in any of the components of autonomous spending, right? And the formula to calculate the multiplier, you know this one from the two sector model, right? You just know this one, or simple Keynesian, 1 minus small letter c for MPC, right? Or, or 1 divided by MPS, right? So far, you just know this one, right? And you also know that the larger the MPC, the larger will be the multiplier, right? That's what you know for now. Before you do this video, make sure that you understand the the first part of this thing of the Keynesian model, right? Make sure you understand chapter 17, right? If you still struggling, just go back to the last video that I posted before this one, right? And just try to make sure that you understand because everything that we're going to be doing here, it's just a build up of what we did in that video. So if you understand that one, it's going to be easy to understand this one as well. Yeah, so you just please make sure that you do understand. Okay, so let's just get into it. Okay, so now they're saying that government expenditure, we consider the impact of government spending on. So you're going to be looking at the impact of government spending or government expenditure on aggregate spending, on equilibrium income, and on the multiplier. Right. Aggregate spending can also be total expenditure or total spending. How does the introduction of spending affect aggregate spending, and how does it affect the equilibrium income? right? Remember the equilibrium income, we said ukuthi we will any point that is here, this is our 45-degree line. Any point that is here in the 45-degree line, it it represents all possible equilibrium points, right? So if there's any point here, let's say we have our aggregate expenditure curve here, so then this will become what our equilibrium. And at any point here in our equilibrium, our aggregate expenditure is the same as our what and our income, right? And this becomes our equilibrium income. I said what? Any point along the 45-degree line represents all possible equilibrium points, right? And I said that whereby now your aggregate expenditure is equal to your income. Yeah. We're going to be looking at that, and also we're going to consider how government expenditure if affect the multiplier, right? Government spending is essentially a political issue, so there is no systematic relationship between government expenditure and income, right? So now they're telling us that government expenditure is a political issue. So there is no relationship between government expenditure and income, meaning that government expenditure is independent of what? Of income, right? So if you see this independent of income, dependent of income, just think of autonomous and induced. Remember when we we're doing when we're looking at the simple Keynesian model and then we're looking at the consumption by household, we said ukuthi consumption expenditure by household is made out of two components, which is induced consumption and autonomous consumption, right? Whereby we said ukuthi autonomous consumption is the consumption that is independent of the level of income. So even if your income is zero, right? Whereby we had our C bar, the C which is like this. We said ukuthi the consumption is made out of induced consumption, which is a C bar, plus autonomous consumption, which was made by C. Then we had our capital letter Y to show that this is for MPC, to show that this one is induced, right? So it is, this consumption is dependent on what? On the level of income, right? So we had those type of consumption, right? So here now they're telling us that because government expenditure is a political issue, it does not have a relationship with income. So it is independent of income. So we can therefore conclude that government expenditure is therefore autonomous in regards to income. That is why you see here they then said this statement can be expressed as G, government spending is what? Is autonomous because it has this bar here, G bar, to show that government expenditure is therefore autonomous in respect to income because it is independent of the level of income. And then graphically, they show it like this, horizontal, right? To indicate that income can increase to here, to here, to here. Government expenditure, if government expenditure is 40, let's say this is 40, government expenditure is going to be 40, right? It will not be affected by what? By the level of income, right? So one thing that we know now that we've learned is that government expenditure is autonomous, right? That's the first thing that we've learned in the slide so far. Government expenditure is what? Is autonomous. Sources of spending in a closed economy with the government. So remember, we are looking now at a closed economy or a three-sector model, right? Three-sector model, where now we have the government as well. So the sources is the households, the firms, and the government. And the symbols for household, we have C for consumption expenditure by households. For firms, we have I for investment spending by firms. And then we know that this I has its I bar here to show that it is autonomous investment. Because remember we said that chapter 17, we said that investment is autonomous. It's not it is independent of income. Remember, and then also have the government, and government is the symbol is G, and then we've just identified that government is also autonomous because it is a political issue, right? That is what we said here. We said government spending is essentially a political issue, so therefore it does not have a relationship with income, right? Government does not have a relationship with income, so therefore it is independent of income. So government is also what? Autonomous. That is why you see here, which is G bar I bar. Right. So now to calculate aggregate expenditure in a three-sector model or in a closed economy, you just say C plus I plus G. You just add all the sources of spending, right? Which is consumption expenditure by household, investment spending by firms, and government expenditure, right? And yeah, which is also autonomous. Government expenditure. The equilibrium. Remember the equilibrium. A aggregate expenditure equal to C plus I in a two-sector model. So remember in a two-sector model, okay, let's look at this graph, right? And let me just use the pencil, like a color ish. Different color. I want to use this one. So we're gonna be talking about this one, right? This one for now. This one it represents the aggregate expenditure in a two-sector model. Can you see, guys? Because it only has what consumption expenditure by household and this I for investment spending by firms, right? And we said Uguti, where our aggregate expenditure meets with our 45-degree line, that becomes what our equilibrium point, right? Because we know that the 45-degree line, it shows all possible equilibrium points, right? Whereby now we know that here, if this is 40, if aggregate expenditure is 40 at equilibrium, income would also be 40 at equilibrium. Equilibrium, right, right. So this what they're saying here, this is the two-sector model. Right. So let me now remove this. Let me just go to this one. With the introduction of the government, the equilibrium is now A equals to C plus I plus G, the three-sector model. Okay, let me firstly explain this one before I move on. So you see here, they're saying that aggregate expenditure equals to C plus I. Remember with the C here, it consists of autonomous consumption plus induced, right? Which is C, small letter C, then capital letter Y, right? Plus induced. So this is autonomous. And this here, let's say this autonomous is 40. Oh no, let me not say 40, because I already have 40 here. So let me just say this is 20. Okay, let's say this autonomous consumption is what is 20, right? So this means here we have what? We have 20. So our graph start at 20, right? Because this is actually telling us that when income is 0, aggregate spending is 20, right? That is because we have these autonomous consumers, right, who are able to spend even if their income is what? Is 0, right? So yeah. And then now we introduce what? The government, right? And then with the introduction of the government, you can see now that the equilibrium point changes from E1 to E2. Let me just use a different color. So we introduced the government sector and it's now C plus I plus G. So, oh no, here I forgot to mention that we also have this I. We also have this I. So let's say this I is investment is, let me just say investment is 10. And then um autonomous autonomous consumption is also 10. Right. So if you say 10 plus 10, you get 20, right? You get 20 because also investment is independent of income. So even if the income is 0, investment will be 10. So if you add the two autonomous components, you get 20. So that's why it's gonna be 20 here. And then also, okay, now let's continue again. I hope this does not confuse you guys. So now we introduced the government, right? We know that this one is autonomous. We also know that now the government is autonomous because it's a political issue. And also here we have that autonomous C, right? that autonomous consumer, right? C bar. Right. So our graph is going to increase obviously because if let's say obviously this was 10 and then let's say maybe now the government expenditure is 20. So to calculate the autonomous components is going to be 10 for autonomous consumption plus 10 for autonomous investment plus 20 for autonomous. Okay, let me not say 20, let me say 25 because I already have 40 here. Let me just say 25. Plus 25 for government expenditure. And then so if you say 10 plus 10, that's 20, plus 25, that's 40, plus 5, that's 45. So here we're going to have what are 45, 45. So you can see our graph is going to increase because we added we added government, right? So our graph is going to increase from here to here. So you can see now that our graph is going to start from what 45 to show that if the income level is 0, aggregate expenditure is 45, right? And then you can see now also our aggregate expenditure is going to increase as well from here, from 40 to this point. Also, the income is going to increase from Y1 to Y2. And also now the equilibrium, it also shift upwards from E1 to E2. Right, the equilibrium is now here because that is where this aggregate expenditure curve is going to be cutting what? This 45-degree line. It looks very, it looks messy. So I just hope you guys are going to be able to understand, even though it looks like this. And then graphically, we have to add G to C plus I at each level of income. The intercept aggregate autonomous aggregate expenditure 1, which is this one, increased by G to autonomous aggregate expenditure 2 to here, right? The whole curve is gonna shift upward. The new aggregate spending curve becomes C plus I plus G, right? So can I just explain the second because um do it on the side, right? Okay, so in a two-sector model, please let's look here. In a two-sector model, we had something like this, and then we had this line here, which is this is our 45-degree line. Now let me just, okay, this was our 45-degree line. And you know that the 45-degree line, it shows all the possible equilibrium point, right? Where now we know what if we said here, it's where we have A equals to Y because we know that any point that is in this line, our aggregate expending is equal to our income, meaning that the point that is in this side is equal to the one that is this side, right? So every point that is here at equilibrium, if this one if this one is 60, your income is also going to what? Is going to be 60, right? Even here at this point here, if your aggregate expenditure is hundreds, your income is also what? Is also 100. It's also 100. So that is our 45-degree line. And then this is aggregate expenditure. And then this is what? This is Y for income or production. And then this is now our what? Our aggregate expenditure curve. Okay, this one is it looks horizontal. Okay. And this is our aggregate expenditure curve, right? Whereby we say it is equal to it's where C equals to, oh no, let me just say A equals to C plus I, right? This is the two-sector model, right? We have something like this in a two-sector model, right? And then with your C, you know that C for consumption, there are two components of consumption, right? We have this consumption here, which is C bar for induced consumption or C0, plus, sorry, autonomous consumption. And then we also have small letter L, this is plus. Also have small letter C and capital letter Y. This one is what is induced consumption, right? It represents induced consumption. And we know that for autonomous consumption, we said that even if our income is zero here, our autonomous consumption is going to be greater than zero, right? Because this is the consumption that is independent of the level of income, right? And I made an example I remember back then. So if our autonomous consumption is 10, for instance, then the graph is going to start here at 10, right? The graph for the consumption function will start at 10. But since here also we have investment, which is also autonomous. So if our investment is 10, it means that investment is also going to, okay, let me just, this is going to be a curve. This will be a curve for the consumption function, right? For this one here, for C, right? And then since we know that our C bar is 10, so it means that here the curve is going to start at what? At 10, right? And this is our curve for investment. And investment is horizontal because it is independent of the level of income. And we said our investment is also 10, so it's going to be 10 here. So now in grouping them together again, we know we're going to have to add these two figures, 10 plus 10, to get what? To get 20, right? So that we can have this curve for aggregate expenditure, because you know that in a two-sector model, your aggregate expenditure is made of C plus I, right? And C, it consists of autonomous consumption and induced, right? And your autonomous, it's independent of income. So even if your income is zero, your autonomous is somewhere there. So it is what? It is 10. Also, your investment is independent of income. So even if your income is zero, your investment is somewhere there. So in grouping these autonomous components, you get 20. So when you're drawing now the aggregate expenditure curve, your curve will start at 20 to show that your autonomous components, they are equal to what? To 20. Right. Hope you're getting this one. And then now we are introduced to another source of spending, which is the government. And then we said, Uguti, the government is also autonomous because um it is independent of the level of income, since you said, Uguti, it's a political issue. And then we drew a graph where we said, Uguti, this is how the curve would look like. And here we would have maybe, let's say, let me just make it 20 here, right? And then this is 0. And then this is Y. This is spending, not agree, just spending. So you can see that even if the income is 0, government expenditure will be 20, right? And it's horizontal like this to show that it is independent of the what? Of the level of income. So because now we're looking at a three-sector model, it's no longer aggregate expenditure equals to C plus I, but it's aggregate expenditure equals to C plus I plus G. So allow me to add a G here, right? Plus G. This is G, right? And we know that this G is what? Has a dash here to show that this is autonomous, right? So if this is 20, and you know that when you're doing your aggregate expenditure curve, it will never start here at the origin at 0, because we have these autonomous components. So it will only start above 0, right? So far, we know that we have consumption, autonomous consumption, which is 10. We also have autonomous investment, which is 10. That is why our graph is starting at 20. But now, because we've introduced the government, and we said the government is also autonomous because the government expenditure is independent of the level of income. So we'd have to also add this 20 here. So now our graph no longer starts at 20, but it's going to start somewhere here. If you say 20 plus 20, it's going to be 40. It's going to start somewhere here. Right. So now your aggregate expenditure. Oh, sorry. I wasn't supposed to add a G here. This should go here. Where now it's C plus I plus G, which is basically this thing here. Right. And you can also see here now that because we've added let me just use different color. Because we have added the government, you can see now that it our curve increases, it shifts from 20 to 40. Now it's starting here at 40. But I wanted to use a different color. Now it's starting here at 40 to show that even our autonomous components have also increased, right, by 20, right? Because we say 40 minus 20, you get 20, right? And then you can see also that the equilibrium was here. Now it is where it is here. And you can also see that the income is also increased from here to here, right? It increased like this. You can also see that even aggregate expenditure has increased from here to here, right? It went up like this, right? So this is basically this here. You can see here we're looking at the simple Keynesian model. We had this consumption expenditure by households and I by firms, right? So we add the autonomous consumption, we also add autonomous investment. We got what? Autonomous aggregate expenditure, which is A1. And then we draw our curve here. This is our equilibrium point, and then this is our income Y1. And then now we introduce the government, and then obviously our autonomous components, they increase. Now we have autonomous consumption, autonomous investment, and autonomous government. So from this autonomous aggregate expenditure, we add the autonomous government, we get A2, right? We get A2, which is this one. Our graph increases from here, from A1 to A2, right? And then you can also see now that um our income, the income increased from Y1 to Y2. Also, the equilibrium also shift from A1 to A2 along the 45-degree line, right? It shifts upward. Yeah, I hope you guys now understand. It's just that government expenditure, the general statement of the equilibrium level of Y0 with government in the model is as follows. So remember this Y0 represents equilibrium income. When we're doing the first part, we said that equilibrium income will be Y star, right? Will be Y star like this, right? So they can use these interchangeably. They can say Y star, they can say Y0 or YE. It's still equilibrium income, right? So the general statement of the equilibrium level of income with the government in the model is as follows. So the equilibrium income, you get it by saying the multiplier, because 1 over 1 minus C, this is the multiplier, right? Um, Times all the autonomous components, right? Because this is autonomous consumption, autonomous investment, as well as autonomous government expenditure, right? So the general formula is a multiplier times autonomous aggregate expenditure, right? This is the formula to calculate what? To calculate the equilibrium income. The impact of government. So now what is the impact of the government? It increases the level of aggregate spending. So as we're adding another component into this model, which is the government, it's going to increase aggregate spending. Obviously, because aggregate spending, you get it by saying A equals to C plus I plus G, right? Because now we're adding this one. Then this one is like this. So obviously, if this was 10 plus, let me just say this was 10, I'm just making an example, and this was 10. That is zero, guys. So it was 20, right? Aggregate expenditure was 20. But now because we're adding another component, maybe say the government is also 10, aggregate expenditure is going to increase to what to 30. So the impact of government is that it's going to increase the level of aggregate spending. And then it leaves the multiplier unchanged. So it doesn't affect the multiplier. As you can see that we have 1 over 1 minus C. So the multiplier is still the same as the multiplier that we had in a two-sector model, right? It raises the equilibrium level of income. So it increased the level of income. You can see that here our income went from Y1 to Y2 when we added the government. Right? So it increases the equilibrium income. And then taxes, recall. Okay, now we're going to be looking at the taxes. Remember, if we're adding the government, obviously taxes are also going um to be added, or when they're going to be involved. Because obviously for the government to be able to spend, the government gets its revenue from us through taxation, right? It's either we pay tax directly or indirect taxes via, which is like VAT, right? But for the government to have revenue and be able to spend, the government also has to firstly collect tax. So they're saying that now recall government spending, which is G, is an injection into the circular flow, right? An injection is basically, it's like an inflow of money into the circular flow. Right, government spending is therefore an injection, while the tax is a leakage or a withdrawal from the circular flow. Right, taxes is an outflow of money in the circular flow because that is money that is not spent, but rather is taken out from the circular flow. So taxes reduce disposable income of household. Right. So remember, when we were doing the consumption function, right, in chapter 17, we did say that the main determinant of consumption is disposable income. Because disposable income, we said that it is the money that you have after taxation, right? So you have your income, then you subtract the taxation, then it becomes equal to disposable income. So disposable income is the money that you have after taxation, the money that you have control over, right? So taxes will reduce your disposable income because if you're to get your disposable income, which is YD, you say income minus taxation, get your disposable income. So if your taxes increase, your disposable income will decrease as well. If your taxes increase, your disposable income will decrease. Right. So to calculate disposable income, it's easy, guys. You just say your income minus taxation, you get disposable income. Right. Or you can say to get your disposable income, you say 1 minus T to get what? To get your disposable income, right? 1 minus T divided by Y, you get your disposable income. Taxes reduce disposable income of households and it also reduces consumption spending by households. Obviously, if your disposable income has been reduced because of an increase in taxation, also your consumption is going to increase because now you have less money to spend. So your consumption spending is going to also increase. Sorry, I keep referring to your. Just keep in mind that we are looking at all the household, right? We're not looking at an individual here. We're looking at the consumption by all the household, right? So yeah, so taxation will reduce disposable income, which essentially reduces consumption expenditure by households because um taxation reduces the amount of money that is available, right? That the consumer can use. So the consumption function, remember we said it's autonomous consumption, which is C bar plus CY, right? But now because we have added the taxation, it's going to be CYD, right? This D to show that it is what? It's now disposable income, right? So it's going to be C bar plus CYD. The C for marginal prosperity to consume, and then YD for what? Disposable income. Right. And you know now to calculate your disposable income, you can say Y minus T. So this can also be written as C plus C into Y minus T. This can also be written like this, right? Y minus T. Or you can just say C plus small letter C for marginal prosperity to consume into 1 minus T Y, right? To show because this is your disposable income. This is your disposable income. Because remember, your disposable income, you can calculate it by saying Y minus T. get your YD. You can also say 1 minus t times y to get your YD. So we can replace this by y minus t or 1 minus t times y, right? So we have to know these formulas to calculate your disposable income. And then they say now, what determines the level of tax? So the level of taxation is determined by the income, because as your income increases, the more tax one pays, right? We know that in South Africa, we adopted the progressive tax system, whereby the higher you earn, the higher you pay, right? So yeah, as income increases, the more tax one pays. The more we spend, the more we pay VAT. So the more we spend on goods and services, the more we pay VAT. And VAT is indirect tax, right? That goes to the government. So yeah, company tax is levied on profit, so it is also related to profit as well as income. So therefore, we can then conclude that tax is related to what? To income, right? So we can then say that tax is not autonomous because it is related to what? To income, right? And then tax T is a certain proportion T of income, and to calculate taxation that is collected in the economy, you say T equals to TY. This T here is basically the tax rate that is paid with every income that is earned, right? With every level of income. Right. So to calculate the total tax that is collected, you just say equals to T, small letter T, Y times Y, which is income, right? So basically what they are telling us in the slide is that with the introduction of the government, right? Because in the Keynesian model, we have now added the government, right? So we reduced the government, and when we added the government, we saw that our aggregate expenditure curve increased, right? And when it increased, let me just And when it increased, we saw that aggregate expenditure also increased as well as income, right? But then the multiplier remained unchanged. But we have to also keep in mind that when we're adding the government, we also have to include taxation, right? Because that's where the government gets its revenue via taxation. So when we're adding taxation, we know that taxation reduces disposable income, right? It reduces the income that one person has. So with by adding taxation, it's also going to affect the consumption function because it's going to reduce the disposable income of the induced consumer. It's not going to affect the autonomous consumer because remember, these autonomous consumers, their income, we said they finance their consumption by credits or by using their savings. So it has no relation to income. However, for an induced consumer, their consumption is related to income. So by the addition of the government, taxes come into play, and taxes are charged to what? To these consumers, whereby their consumption is related to income. Those consumers that their consumption is related to income. So for an unjust consumer now, their disposable income is going to decrease because of an introduction of what? Of taxation. Right? Taxation reduced their disposable income. So to calculate disposable income, because we said disposable income is the income that a person has after taxation. So to calculate it, you say y minus t, you get yd for disposable income. Or you can say 1 minus t times y, you get yd for disposable income. And then I said that this formula then now changes to C plus C for autonomous consumption plus small letter c for MPC, um, open bracket, y minus t. And this y minus t is for what? Is for disposable income. Or you can just say autonomous consumption plus c times 1 minus t times y. And this y minus t times y, this represents the disposable income, right? And then we also said ukuthi, the taxes reduce disposable income, which then also reduced consumption spending by household because a reduction in the taxes, it reduces the money that is now available to a household, right? obviously now if the money that is available is decreased, it's going to also reduce your consumption because now you can now spend that money on fewer goods. Right? You can now buy um the goods that you can now buy are less compared to the goods, the amount of goods that you were gonna be able to buy if there were no taxes, right? And then we then also went on to say that what determines the level of taxes is income, right? Because an increase in income will increase taxation, and also because the more we spend, the more tax we pay, and so on, right? By determining that the taxes is determined by the income, we then came to a conclusion that therefore taxation is not autonomous, right? Is not autonomous because it is dependent on the level of income. For you to be able to pay tax, you have to have income, right? You have to have earned something. You need to have earned something so that you are able to do what now to pay tax. So we then came to a conclusion that okay, therefore taxation is not autonomous, right? Because it is not dependent on the level of income. Sorry, I mean because it is dependent on income, right? It depends on income. The higher you earn, the higher you pay. So taxation is dependent on what? On income. Right. So the graph for taxation, it will start somewhere here at zero to show that if your income is zero, taxation you pay will be zero. Right. If you have T for tax, but you're gonna see this in the next slide. But if you have T for tax and Y here for income, your graph is gonna start here to show that if your income is zero, your taxation is zero. Right. You're not gonna pay tax if you're not earning anything. Right. Your income is gonna Your taxation will be zero if your income is zero. But as your income increases to this point and this point, your taxation also does what? It increases. So therefore, tax is dependent on what? On income. So taxation is not autonomous. Right. And then now to calculate also tax, the total tax that is collected is equal to small letter t times y for income. And this t, we said that is basically the interest rate that is paid with every level is the tax rate that is paid with every level of income, right? Yeah, guys. So what you have to know here is how to calculate total tax, which is small letter t times ty, and also that your taxation reduce disposable income. And then how to calculate disposable income, you say y minus t, which is income minus taxation, you get your disposable income. Or you can say y minus t times y, get your disposable income. Taxation is a function of income. According to the graph, when income is zero, taxation is zero. So you can see here when the income is zero, your taxation is zero. Then y income is 500, then the slope is given by 0.2. So when the income is 500, you can see that your taxation is somewhere here, 100. To calculate the slope, you know you're going to use the formula which say y2 minus y1 divided by x2 minus x1. So y2, you're going to say 100 minus y1, which is 0, divided by x2, 500, minus x1, which is 0. Then you're going to get 1 over 5, which is 0.2, right? So the tax rate is 20%. Right. And then now to calculate the total tax, you know, we share T is equal to TY. So you're going to take the 0.2 times the income, which is 500. Then you're going to get 200. So tax that will be collected is what? Is 200. Um, Taxes continue. They're saying that tax is a leakage or withdrawal from the circular flow. So tax is a leakage. The introduction of proportional income tax reduces the size of the multiplier. So the introduction of the proportional income tax, which is the tax rate, that small letter t, it reduces the size of the multiplier. That is because when you're calculating the multiplier in a simple Keynesian model or in a two-sector model, we say 1 divided by 1 minus C, right? We get the multiplier. But with taxation, to calculate the multiplier, we say 1 divided by 1 minus C times 1 minus T, right? And this will then reduce what? The size of the multiplier. Graphically, the introduction of tax swivels the consumption function downward. So you can see here, we're just looking at the consumption function only, right? Our consumption function was here, was somewhere here, whereby we had our autonomous consumption plus our induced consumption, which is just CY, right? But now because we've introduced taxation, our CY here, you know now that this Y is supposed to be disposable income. And I did show you guys the formula to calculate disposable income, right? We said that to calculate disposable income, we can say YD equals to your income, your minus your taxation. Or you can also say your YD is equals to, that is D, guys. This is D, is equals to, you open your bracket, 1 minus T times Y, right? So with the introduction of taxes, this Y no longer just becomes income, but it becomes what? YD for disposable income. And this is how you calculate disposable income. So the equation changes now to C, or here, to C plus CYD, which can be written as C bar plus C into 1 minus T times Y. Right, so they use this one. Equilibrium level of income with the government sector. Algebraically, it is obtained by multiplying autonomous spending, which is A bar, by the multiplier. So to calculate the equilibrium level of income, you take your multiplier, multiply by your aggregate autonomous spending, right? Because it's A bar, right? So include all the autonomous components, then you multiply them by the multiplier. Right. So with the government, remember the government, because this, you see, this might confuse you guys. This thing here. They said here, Guti, that the government, it leaves the multiplier unchanged. This one, where I said, Guti, we have over 1 minus C, right? It leaves the multiplier unchanged, right? That is just for you to know that with the government, it leaves the multiplier unchanged. However, we know that if we're adding the government, also we're going to add taxation, right? So when we introduce the government, and then we also introduce taxation. Taxation will then cause up the multiplier to do what? To change. That is why the multiplier now becomes 1 over 1 minus C times 1 minus T. Because now we've introduced what? Taxation, which taxation, it does what? It reduces the size of the multiplier. Hence now, the equilibrium income is calculated like this. You say 1 over 1 minus C, then you take into account that we have also introduced the government, which comes with taxation, right? And taxation reduces the size of the multiplier, right? And now we're going to now divide also by 1 minus T, right? So I hope I didn't confuse you guys. Okay, yeah, it's just like that. And then so the multiplier times autonomous aggregate expenditure, right? And remember now we're looking at a three-sector model. So our aggregate expenditures, our autonomous aggregate expenditure is made out of autonomous consumption, autonomous investment, and autonomous government expenditure, right? So the general equation can be written as Y0 or Y star is equal to alpha, which is a multiplier times aggregate autonomous expenditure, right? And then they're showing us here, this is the same thing that we've been looking at. So this was the aggregate expenditure, where we had, okay, what is happening here? All the autonomous components are grouped together. and then we just have CY. So this was our initial aggregate expenditure curve, which is A1. And this is where we have our equilibrium, E1, whereby our aggregate expenditure is equal to autonomous aggregate expenditure plus CY, right? And we know that here it's basically where we have our C introduce the government. So this is basically here where we have our C plus I, right? And then I think they grouped I here along with the autonomous consumption. They also grouped autonomous investment here plus CY, right? And then A1, obviously it consists of autonomous consumption plus autonomous investment, right? Equals to aggregate autonomous expenditure, which is this one here. And then obviously if you add them together, you're going to get this amount that is going to be here, right? And then they introduced the government. Obviously our curve then now increases, right? Our aggregate expenditure increases with the introduction of the government. So it went from here to here. So you can see now it is here, it's A2. So from C plus I, now they introduce what? The G, right? Autonomous government expenditure, right? This is G, this is plus. So they introduced the G, and then our A2 is here, our autonomous aggregate expenditure is here. And then obviously when we introduce GG, have to keep in mind because we're gonna also introduce taxation. And taxation reduce what? Your disposable income. And to calculate your disposable income, you say 1 minus T times Y. So they then replace this Y by 1 minus T times Y to show now that this is YD, right? To show that this is now C bar plus small letter C Y D, right? To show now that this is YD, they said 1 minus T times Y. And then we said ukuthi taxation reduced the size of the multiplier, hence the graph is going to now shift downwards like that, right? So the equilibrium now becomes E3, and our income now decreases. Taxation, you see, taxation is going to reduce the income, and it's also going to reduce aggregate expenditure because aggregate expenditure was here when we did not consider taxation, when we looked only at the government, at the increase of the government. Taxation was, income was here at Y2 and aggregate expenditure was here. But now because we have also introduced taxation, taxation is going to do what? To increase aggregate expenditure and also the income. Hence now our new equilibrium is what? Is E3. Right. And to calculate your equilibrium income, you just say the multiplier. You calculate it by saying 1 divided by 1 minus C times 1 minus T times your autonomous aggregate expenditure. Now you add all the aggregate. So basically you just take this, you put it here, right? You just take this and put it here because you just add all the autonomous components of spending, which is autonomous consumption, autonomous investment, and autonomous government expenditure as well. Darling. Okay, the multiplier with the government and tax. The formula for calculating the multiplier in a closed economy or in a three-sector model, you just say multiplier equals to 1 divided by 1 minus C times 1 minus T, where your small letter C stands for the marginal price paid to consume, and your small letter T stands for tax rate. And remember, to calculate the total tax that is collected, you say T, the tax rate, times the income, right? T times Y. A proportional tax is a fixed percentage levied on all taxpayers at all levels of income. So this T here is a proportional tax that is a fixed percentage which is levied on all taxpayers at all level of income. Individual exercise. Okay, so I hope you guys did understand what we were doing. So yeah, so we were looking at the Keynesian model, and then we introduced government. Then obviously when we introduced the government, we realized that okay, government is autonomous because it is independent of the level of income, because we said that government is just it is a political issue, right? So now we came with the conclusion that therefore government is equal to G bar because it's autonomous. And then we also said within the closed economy, we have three sources of spending, or in a three-sector model, which is the households, the firms, and the government. Now, to calculate aggregate expenditure in a closed economy, we just say C plus I plus G. And our I and G, we know that they are autonomous because investment is autonomous. It's independent of income, and government is also independent of what? Of income. It's like that. And then also now we draw the aggregate expenditure curve when we're introducing the government. It's going to increase obviously because our autonomous components are increasing, right? When we're just looking at the two-sector model, our autonomous component was just autonomous consumption and autonomous investment, which we add them together and we give it becomes autonomous aggregate expenditure one, which is here. But now because we also include autonomous government expenditure, then our autonomous increases from here to A2, right? A2 to A2 bar to here, right? We can see that by introducing the government, our expenditure is going to increase, aggregate expenditure increases as well as the income, but the multiplier does not change. However, if we introduce the government also comes with taxation, right? Because government also has to collect taxes from us so that the government can have the revenue that is going to use in order to spend, right? So we said okay, the introduction of taxes then has a direct impact on what? On our disposable income because it reduces our disposable income, right? The household's disposable income. And to calculate disposable income, we say Y minus T, which is income minus taxation, you get disposable income. Or you can say 1 minus T, which is the tax rate, times Y to get your disposable income. So the consumption function now, since the disposable income also reduces the consumption expenditure by households, the consumption function then changes from C bar plus CY to C bar plus CY times D to show now that is what? Disposable income. And to calculate disposable income, we can replace this YD by this or by this. Right. And also said that since taxation is dependent on the level of income, because for you to be able to pay tax, you need to have a certain amount, right? You need to have income, right? So so therefore taxation is not autonomous in that case because it is dependent on the level of income. And then to calculate the total tax that is collected in the economy, we said with T times Y, which is the tax rate times your income. Then we said that taxation, because it is not autonomous, it is dependent on your income. If your income is zero, your taxation will be zero. You can see here. So that's why the curve for taxation is start at what? At origin, at zero here. And then to calculate TY, we know that we're going to say small letter t times y, which is the tax rate. And the tax rate is basically the slope of the curve. To calculate the slope, we basically use the gradient formula, which say y2 minus y1 divided by x2 minus x1. So we said 100 minus 0 divided by 500 minus 0, and we got 1 over 5, which is 0.2. And to calculate the total tax that is collected, we just say 0.2 times income, which is 500, and we got 200. And then we said that now the taxes, they reduce the size of the multiplier. That is because in a two-sector model, to calculate the multiplier, you say 1 divided by 1 minus C. But in the three-sector model that consists of the government or an open economy, we say to calculate the multiplier, we say 1 divided by 1 minus C times 1 minus T, which is the tax rate. And this will reduce the size of the multiplier, right? And so now, since taxation affect disposable income, we are looking here only at the consumption function, right? This is the curve for the consumption. So whereby now we said it's autonomous consumption plus induced consumption. It was here, right, without taxation. But since now we include taxation, this here, the induced C plus Y will change to C. C times Y will change to C times Y times D to show that this is now that this is no longer just any income, but it's disposable income, which can be written as Y minus TY, which is 1 minus T times Y, right? Income, okay, we also looked at this one with the government. Okay, this one is still the same way. Now we said routine. Now to calculate the equilibrium level of income, you take the multiplier, you multiply by all the autonomous components of aggregate expenditure, right? Which is autonomous consumption, autonomous investment, and autonomous government expenditure. And then to calculate the multiplier with the government and the taxes, you say 1 divided by 1 minus C, which is your marginal prosperity consumed, times 1 minus T, which is your tax rate. Now let's do this individual exercise. They say that use the multiplier approach to solve for the equilibrium income. So they want us to use the multiplier approach. So we're going to use the one that says the multiplier times aggregate autonomous expenditure, this one. So we're going to say 1 divided by 1 minus C times 1 minus T, multiplied by all the autonomous component of aggregate expenditure. Wish I thought they were answers somewhere. Okay, let's just do it. I'm just gonna, because I don't have a space here, which can't even see my calculator. Oh, here. So we're just gonna say, firstly, we're gonna calculate the multiplier because they're saying that we're using the multiplier approach. So it's gonna be 1 divided by 1 minus small letter c. So you know that your c is here, which is 0, 0.5. So this is going to be 0, 0.5. Then you're going to open your bracket. You're going to say 1 minus t. Where's our t? T is here. Because you know that to calculate your net taxes, it's small letter t times y, right? So t is 0, 0.25. So you're going to say 1 minus 0, 0.25. Right, so let me just say 1 divided by 1 minus 0, 0.5 times 1 minus 0, 0.25 divided by. So you're getting 1,6. But when you're doing it, this in the exam, firstly you need to solve for you need to use the BODMAS rule. Yeah, let me just say that. So I'm getting 1,6 because I just like edit everything in the calculator. And then now you're going to take your multiplier, which is 1,6. Then you're going to multiply by all that element of autonomous expenditure. Let me just open my bracket. These are bracket, guys. So autonomous, we firstly have autonomous consumption, which is this one, which is 85. We know that investment is also autonomous, 75. We know that government expenditure is also autonomous, so plus 70. And I'm getting what? 230. So you're going to say 230. So 1,6 times 230, 1,6 times 230. You're getting 365. So your equilibrium income is what? Is 360. Oh no, 68. Right. Then they say now, how much does the government collect in taxes when the economy is in equilibrium? So when the economy is in equilibrium, the income is this amount, right? This is the income. So how much will the government collect? So to get the taxes that is collected, I did say, Guti, you say T time is equal to small letter t times y, right? So it's this one, guys, where you say T equals to TY. They even said their notes, or they said remember. Let me just go back. But I didn't read it, so yeah, they said remember T is equal to T times Y. Right. So to get the total text that is collected, you say T times Y. So we know that our T is 0, 0.25, right? So you're gonna say 0, 0.25, and then in the place of Y, you're gonna substitute this 360, this 368. Right, to get the text that is collected. So if you say 0, 0.25 multiplied by 368, you get what? 92. So net taxes is what? Is 92. Then they said, what is the government budget deficit or surplus? So to see if the government deficit or surplus, you basically going to compare the revenue that the government earns with the what? With the government expenditure. So if the revenue is greater than government expenditure, then G, then we have a surplus, right? SU for surplus. But if the revenue is less than G, then we have a deficit, right? D for deficit. So we can see now, Tina, our revenue is 92, right? Because this is the tax that is collected. Remember I said that the government gets its revenue by collecting taxes, right? So this is the government revenue, which is 92. And the government spending is 70. So the government spending is what? Is 70. So you can see that the revenue is greater than government expenditure. So this is a what? This is a surplus. Surplus of how much? If you say 92 minus 70, the surplus is 23. Okay, so we're done with this one as well. Okay, so we're looking at the three sector model. Now we're going to introduce the foreign sector. This is part two. So the foreign sector, now because we're introducing the foreign sector, it becomes the four sector model. Or what? Or an open economy, right? Because now we are able to interact with the rest of the world, right? So they're saying that export X serves as an injection into the circular flow. So export is an injection in the circular flow. Injection is basically um the inflow of money into the circular flow. So obviously export are an injection because when people are buying our product, money is being spent in our economy, right? So it is an inflow. And then import Z, import is denoted by Z, or they can also write M, so don't be confused. So import is a leakage from the system which decreases income. So import is a leakage because that is the outflow of money in circulation, because that is the money that is spent outside, right? So that is you spending your money by buying clothes from Shein, and yeah. Total income and production are represented by. So now to calculate total income and production, you say C plus I plus G plus X minus Z, right? In a four sector model, right? Because it consists of what? The foreign sector. X for export, we add the export because that is an injection in the economy. So that is money that is spent within the economy. And that is expenditure that happens domestically, right? And export, we subtract them because that is a leakage, right? Money is leaving the circular flow, right? It is being spent outside. So that is subtracted. There is no systematic relationship between the level of export and the level of income. So export does not have a relationship with income. So export is therefore independent of the level of income, right? So we can say that export is autonomous, okay, right? Because it's independent of the level of income. And this is true, guys, because like the people that buy our product, right? Remember, exports is like us selling our things to people in America, right? Or in the US, like outside. So export then does not depend on income. It does not depend on our income, right? Because remember, we're looking at at we're basically studying, let me just say South Africa, right? So we're looking at South Africa. So export, it does not affect our income, right? The citizens' income, but it affects the income of people that are in the US, right? So for us here, export does not have any relation with income. It is independent of income. Do you guys understand that? Yeah, I hope you guys do. So export is autonomous, okay? Right? Because it does not depend, it's independent of income. So you can see here, the curve is just horizontal like that to show that export is what is independent of what? Of income. Therefore, export are autonomous with respect to income, and then your X is like that, but then it can also be written as X bar to show that export are what? Autonomous, right? They're independent of what? Of income. The foreign sector, export and import. Import reduce aggregate spending and therefore also total income. So now we're looking at the import. They're saying that the import reduce aggregate spending. Obviously, you can see here what imports are separated. So obviously they reduce aggregate spending, right? Because if you were to add, let's say all of these was 10, right? So if this was 10, 10, 10 plus 10, that would be what? 10, 20, 30, that would be 40. Then you're gonna minus, so your aggregate spending will be equals to 40. Plus because of import, now you have to minus this another 10. So it's gonna be 30. So you can see that to import, they reduce your aggregate expenditure and your income. Remember, because here we said that Y is equals to A is equals to GDP is equal to C plus I plus G. This is what I'm talking about. A equals to Y equals to 1, 1, 1, 1, 1. So yeah. And then they're saying that, and therefore total income. So it also reduces total income. Remember, we said that Y, this one Y, it can stand for total production. It can also stand for total income. That's Y here. If income is the main determinant of Z, which is import, then Z function resembles the C function, right? So they're saying that now if income is the main determinant of export, then the Z function, which is the import function, will resemble the C function, which is the consumption function. Remember, the consumption function is given by autonomous consumption plus small letter C and then Y. Remember now, our Y has what? Has Y? D. Yo, guys, that is D. Right. So also our consumption function will also say that consumption is dependent on the level of income, right? Because with the consumption, we have two component of consumption. We have induced and autonomous. And autonomous is the one that we said it's independent of the level of income. And then induced is the one where we said it is dependent on the level of income. So also with the export, remember we said since income is the main determinant of export, then Z resembles the C function, meaning that the export function now looks something like this. Okay, here it is, right? Whereby now this Z here, it it shows you, okay, we with the import as well, we also have autonomous, for import, we also have autonomous component as well as induced component, right, of import. So autonomous, that is the imports that happens even when your income level is zero, right? And then it means that you are able to buy goods from outside even if your income level is zero, right? And then plus MY, which is an induced component of imports, whereby now we said these are households that are able to import product, but their import is dependent on the level of their income. This M represents marginal prosperity to import, right? And they said that M is a fraction of any increase in domestic income that is spent on imports. So remember when we were looking at consumption function, we were saying that with every 1 rand increase in income, this is how much will be spent, right? MPC is telling us that with every 1 rand increase in income, this is how much will be spent of that increase. Same thing with the import, because this one is an induced component or induced imports. It's telling us that with every increase in income, this is how much will be imported of that increase, right? This is how much will be imported, right? So yeah, so the Z function or the Z function or the import function is given by autonomous import plus induced import. That autonomous, which is Z bar plus M for marginal prosperity to import times Y. So in this slide, just one thing that you had to pick up is that the main determinant of import is income, because for you to buy things from outside, you have to have certain amount of money, right? And also that the Z function, the import function, it resembles the C function, right? The consumption function. That is because for import, we also have autonomous component of import and we also have induced component of import, right? Where now for the autonomous, it's represented by Z bar plus for an induced component, it's MY, right? M for marginal prospect to import and Y for income. Right, so with every 1 rand increase in income, this is how much of that increase that will be. Okay, let me just say this was 0.2. This M, let's say M, let me just, okay, no. If this M was 0.2, this means that if income with every 1 rand increase in income, 0.2 of that increase will be spent on imports, right? And then the sources of spending in the open economy, because now we're looking at an open economy that consists of the foreign sector, or rather called the four-sector model. So the sources that we have is the households, the firms, the government, and the foreign sector. So the household, the symbol is C, which is consumption expenditure by households. The firm, the symbol is I, which is investment spending by firm. And we know that investment is autonomous. For government, it is G, which is government expenditure. And it is also autonomous because it is just a political issue. So it is independent of the level of income. And then net export. To calculate net export, you said export minus import. That imports are subtracted. And you said that export reduces total production and income, right? Because they are subtracted. And also that the import resembles the what? The C function, right? The import function resembles the C function, right? Because with the import, we also have autonomous component and induced components, right? So now to calculate aggregate expenditure, which is equal to income, which is equal to GDP, you just say C plus I plus G plus X minus Z. And remember, these are the components, they are autonomous. That is why we have that. And also here we subtract the Z that is autonomous. So we subtract um the autonomous component of import. Right. So aggregate expenditure, you can also see now that if we're adding more components, the aggregate expenditure curve increases. So this was just for the two-sector model or the simple Keynesian model where we had C plus I. Then we added the government. You can see now the curve increased from here to here. We also added now another sources of spending, which is the foreign sector. The curve also increased from here to here. And as it increases, obviously, our income as well as aggregate expenditure also increase. Because if I were to draw the 45-degree line here, you will see that it was here, the equilibrium was here, now it is here, now it is here. So you can see that even the income is increasing as well as aggregate expenditure is increasing. Okay, so mm, and then the foreign sector export and import. So they're saying here with the inclusion of the foreign sector, the equilibrium level of income is represented as follows. So now with the inclusion of the foreign sector to calculate the equilibrium income, we now say 1 divided by, this is the multiplier, right? The formula is still the same. Can you guys see that? The formula is still the same. It's still the multiplier times the aggregate over autonomous component of aggregate expenditure, right? It's just that now with the multiplier, we've added this part here, which is plus M, plus the marginal percentage to import, and then also our aggregate components, we've added these two, right? So you just say in equilibrium income equals to the multiplier times all the autonomous components of aggregate expenditure. When now to calculate the multiplier, you say 1 divided by 1 minus C for the two-sector model, and then 1 minus T, three-sector model, plus M, that is the four-sector model. And then multiply by C plus I plus G, all the autonomous components of aggregate expenditure, which is consumption, autonomous consumption, autonomous investment, autonomous government expenditure, autonomous export, and minus autonomous import. Right. So the formula is still the same. The calculations are still the same. It's just now for the multiplier, we've added plus M, and also we've added these two in aggregate spending. The multiplier with the foreign sector in the open economy. So the formula for calculating the multiplier in an open economy with the government, taxation, and the foreign sector now becomes 1 divided by 1 minus C times 1 minus T. That is because we added the government and taxation, plus M. That is because now we added what? The foreign sector. So it's 1 divided by 1 minus C times 1 minus T plus M, where M is your marginal prosperity to import. Right. Summary. The multiplier alpha. So multiplier without taxes, it's 1 divided by 1 minus C. Right. In a simple Keynesian model, remember, it was 1 divided by 1 minus C. Or when we've just included the government, but we haven't included taxation, it's going to be 1 divided by 1 minus C, where your C is your marginal prosperity to consume. But with the taxes now, it's going to be 1 divided by 1 minus C times 1 minus T, where your T is your tax proportion of income or your tax rate. You must remember that taxation reduced the size of the multiplier, right? And then multiply with the import now, it's going to be 1 divided by 1 minus C times 1 minus T plus M, where your M is your marginal prosperity to import. And then methods of calculating equilibrium level of income. So there are two ways you can calculate equilibrium income in a four-sector model or in an open economy. Number one, you can use this way or this one. Or you can use this way using the multiplier approach, or you can use the total expenditure approach. So using the multiplier approach, you can calculate it by saying that a change in income is equals to multiplier times a change in any component of aggregate expenditure. Right? So if they gave you maybe a change in government expenditure, so it's going to be a change in C. Right? So you're going to say multiplier times a change in C to get change in income. Right? If you're given investment, or it's going to depend which one you're given. And also it's going to depend on the question, right? But the formula is a change in income is equal to the multiplier times a change in any component of aggregate expenditure. And then number two, you then take that figure that you get, which will be equals to your change in income. You add it to your old equilibrium income. So you say old equilibrium income plus a change in income, you get your Y1. Right, you get your new equilibrium income. So this is like this, right? So you have something like this, right? And then let's say this is your equilibrium income, right? This is Y. This looks horizontal, but it's not, guys. And then maybe they say that maybe your multiplier is 2, right? And your income is hundreds. No, let me just say it's 10. And then your multiplier is 2. Then they tell you that the change in government is, no, they tell you that government expenditure is now 250. And before that, you know that you were given here that A is equal to C plus I plus G. And then in the place of G, maybe they said that government is 50. Right. So you know that government is currently 50. And then they say now that assume that the government expenditure is now 150. Right. And then they say now calculate the equilibrium income using the multiplier approach. So you can just say 150 minus 50 to get the change in government expenditure. So to see what's okay, what was the change? Because it was 50, now they're saying it's 150. So you just say 150 minus 50, you get what's okay. It's the change is what? It's hundreds. It's 100. Right, so you're just going to say the multiplier, which is 2 times 100, which is a change in government expenditure. And then we're going to get to 2 times 100, you're going to get 200. So the change in income is also what? 200. And then you just take now your change in income, you take it here. So it's going to be 200 plus your old income, it was 10. So plus 10. So if you say 10 plus 200, then the new equilibrium income is what? Is 210. So now you know that here your new equilibrium income is going to what? 210. Your 210. And here where your curve is going to start also, you're going to increase it by this amount by 10 because your government increased from 50 to 150, so it increased by 10. So your autonomous components are increasing. So let's say maybe here your autonomous components were, I don't know, maybe like, yeah, something you're gonna add plus hundreds, then it's going to be here. But you're gonna see when we do the questions, I think there is a question in regards to this. And then another way of calculating using the multiplier, you can just say a multiplier times all autonomous aggregate component. All the yeah, all the autonomous component of aggregate expenditure, which is your C plus I plus G plus X minus Z, right? So here's our multiplier, and then here they are. And then using the total expenditure method, you just say income equal to C plus I plus G plus X minus Z. But now here, the tricky part here that you have to remember when you're using the aggregate expenditure is that your C is okay here. Is that C looks like this. And also your Z, this one, don't forget it looks like this. It is Z. What is happening here? Oh no, the Z is Z plus M Y. They forgot a Y here. Yeah, yeah. So your Z also looks like this. Then now you have your autonomous component of import plus your induced component of import, right? Then your income also we're gonna look at this because remember we said that taxation will reduce your disposable income. And to get your disposable income, which is CYD. So to get this YD here, you say that you're gonna use this, right? This part here, which is 1 minus T times Y. Or you can just use this one, which is Y minus T. Depends what you have, what are you given, and then yeah. So now you know how to calculate equilibrium income in a four-sector model. Now let's continue. Oh, now let's look at the questions. So let me see. Okay, okay, so let's do this one. They're saying that calculate total autonomous expenditure. They just want us to only calculate autonomous expenditure. So they want us to calculate only the autonomous component. They want us to calculate this part, this thing here, right? A bar. So you're just gonna add your C bar plus the I bar plus your X bar minus your Z bar. So we're going to say exercise 1, right? Yeah. So you're going to say 200 plus 100 plus 250 plus 200 minus 50. You're going to get 700. So your autonomous expenditure is what? Is 700. So 0, 0, right? We said 200 plus 100 plus 250 plus 200 minus 50. Then they say, and hence use the multiplier approach to calculate the equilibrium level of income. So when using the multiplier approach, you know that you just say multiplier times your autonomous component of accurate expenditure, right? And we've calculated them, go to 700. So we already know, go to here, we have 700. And then now what is missing is for us now to calculate the multiplier bracket. So now we just have to calculate the multiplier. And we know that to calculate the multiplier, you just say, let me just write here. You just say 1 over 1 minus C, which is MPC. MPC is here, right? 0, 0.9, 0, 0.9. And then you open your bracket, you say 1 minus the tax rate, which is 20. So if you say 20, you just say 20 divided by 100, you get 0, 0.2. Then you have 0, 0.2 plus your marginal prosperity to import. So marginal prosperity to import is this one, right? Because we know that this formula, it says Z plus Z bar autonomous plus M Y, right? So this is the M. So it's 0, 0.12. 0, 0.12. And then you use the BODMAS rule when you're doing this. You're gonna first solve for this, and then it's bracket of BOD division, BODMAS, multiplication, addition, and subtraction. So you're gonna use this. So Minagi, I'm just gonna place everything in the calculator for now. So it's 1 minus 0, 0.9 which is the MPC, and then times 1 minus 0, 0.2 plus 0, 0.12. Then my multiplier is 2.5. So I'm gonna say 2.5 times 700. So 2, there's supposed to be a comma, guys. So 2.5 times 700. So if you say 2.5 times 700, you get 1,750. So 1,750. So the equilibrium income is 1,750. And I did see, Guti, they said, Guti, you must graphically illustrate it, and they did. There is a graph here. So here's a graph. You can see we have 1,750, which is our equilibrium income, right? It's here. And then 700 is here because these are all the autonomous we added all the autonomous component of aggregate expenditure, right? So it's 700. And then this is our 45-degree line. And then this is our aggregate expenditure. And then we added all the autonomous component of aggregate expenditure. We got 700. And then this is our income. We know that here, if our income is 1,750 at this point, aggregate expenditure related with this point would also be 1,750. Right. And they say now, does the government budget exhibit a budget deficit or a surplus? Assume that the government collects income by means of taxes only. So the income of the government is just the taxes. So to calculate total taxation, you know that I'm going to write here, to get your total tax that is collected, you just say equals to small letter t for the tax rate times y for income. So our t is 20%, which is 0, 0.2 times our income. We've calculated our equilibrium income to be 1,750. So we're just going to say 1 times 1,750. And then, so if you say 0, 0.2 times 1,750, 1,750, you get 350. So the tax that is collected is what? Is 350, right? So now, and then the government spending is 250, right? So you can see that the tax revenue is greater than the government spending. So this is what? This is a surplus, right? Because the revenue is greater than the expenditure. So if you say 350 minus 250, you're going to get hundreds. So it's the surplus is what is hundreds. Let's look at another question. Okay, this one. This one is the same as the one that we were doing. It's the same with this one. Calculate multiplier. Or we did calculate the multiplier. They calculate SA equilibrium income, deficit or surplus. This one is the same, guys. So let me do. Then calculate economic equilibrium income level by means of total expenditure approach. Okay, here the approach is different, but it's still the same thing. So they want us now to use the total expenditure approach. And you know that when you're using the total expenditure approach, you say, let me just say accurate expenditure. They wanted to calculate what the income. So Y is equals to, okay, basically you add everything. It's going to be C plus I plus G plus X minus Z, right? And then you need to take into consideration that this one, this C, is C bar plus CY. And also this Y is not just any Y, but to calculate this Y, I mean, you remember we said this is now YD, right? So to calculate YD, you can say your income minus taxation. It will depend which one what are you given, or you can say bracket 1 minus T times Y, right? And then also with this one, you also need to remember that this one is also Z bar plus M for marginal prosperity to import, and then Y for income. So now let's calculate again. For C, so for our C, we are just going to use this one. It's 100 plus 0.75, which is 0.75. And then obviously, remember we need to calculate disposable income, right? So it's not just, we're not going to say YD like this. We need to calculate disposable income. And then to do that, we say 1 minus T. And our T is 20. So if you say 20 divided by 100, you get 0.2. It's going to be 0.2 times Y, right? And then you're going to add plus I, which is 200, plus G, which is 150, government expenditure, plus, let me just do this. And then plus G, plus export, which is 200. Let me just, okay, 200, minus, open the bracket, 150 plus 0.4, 0.4, Y. Then you close your bracket. So this is what you have. Okay, Ish, I forgot to say Y equals to, and this is not just any Y, this is the equilibrium income, right? So it should be Y star, there's a star, or you can say Y zero, right? So, and then now you're just gonna, obviously you're gonna start by solving the bracket. So you're gonna say 1 minus 0.2. So 1 minus 0.2, you get what? 0.8. So this one is 0.8. And then if you say 0.8 times 0.75, so 0.75 times 0.8, gonna get 0.6. So So basically here we have 0.6. We can just remove 0.8 here. Oh, Jehovah. Ew. Okay, ish. No. Let me see. Yeah, let's just use this one. So you can see here, we said 1 minus 0.2 we got 0.8, and then you said 0.8 times 0.75 we got 0.6, right, times y. And then okay. And then so now we're done with solving the brackets. We got 0.6y. Then also come this side to solve for this bracket as well. So we're going to say, oh, it's 150 plus 0.4. So 150 times negative is going to be negative 150. Positive 0.4y times negative is going to be negative 0.4y. Then now we just group the like terms. So we're going to say 100 plus 200 plus 150 plus 200 minus 150. We're going to get 500. Then we're going to say 0.6y minus 0.4. So if you say 0.6 minus 0.4, you're going to get 0.2. And then you're going to take that to the other side. Oh, they didn't do it like that here. Okay, let me just, so let's ignore this part. So from here, it is y equals to, I said 0.6y minus 0.4, I got 0.2. So there's going to be 0.2y plus 500, right? Remember we got 500. So plus 500. Then I was going to take this to the other side. So it's going to be minus 0.2y, 0.2y equals to 500, right? 500. And then remember here we have an invisible one. So if you say 1 minus 0.2, you're going to get 0.8. So you're going to be 0.8, 0.8y equals to 500. Then you're going to divide by 0.8 on both sides, divided by 0.8, divided by 0.8. Yeah. And then you're going to get y equal to this 625. All right. So yeah, we just had to do that. And then, yeah. And then if you were to show this in a graph, it would look something like this. So this is your 45-degree line where A is equals to Y. Then this is will be your curve. And then your income here would be 625. 625. And then your aggregate components here, autonomous components, you're just going to add this plus this plus this plus this minus 150. Then you write here the amount. I think it's 500. Yeah, it's going to be 500. Let me just see. 100 plus 200 plus 150 plus 200 minus 150. Yeah, it's 500. So yeah, we are done. Then here they're saying calculate the equilibrium income for the country using total aggregate expenditure method. This is the method that we're using. So it's the same thing. Okay, this one might be tricky, but it's the same thing. Let me just. So we are using the same method, right? Which basically say for what happened. So for your income is going to be equals to C plus your C plus I plus G plus X minus Z or M. So C plus I plus G. And then you know that your C is autonomous plus induced, right? So it's going to be, because you told here household expenditure is 215. It's gonna be 215 plus C, sorry, plus C, which is the marginal prosperity to consume. So where's our C here? Margin 0.85. It's gonna be 0.85 into 1 minus, to calculate your disposable income, right? So it's 1 minus T, and the tax rate is 20%. So this is 0.2, right? Each 0 times income Y plus investment with investment, it's 285. So it's 285 plus government expenditure 520, so 420 plus your export 245, 245, and then minus, open your bracket, um your autonomous component of export, so of import, I mean. So we're given 105, right? So it's 105 plus your M for marginal prosperity to import, which is 15, right? Remember, for your import, you have that Z bar plus MY, right? So this is the M. You should know, it's going to be 0.15, 0.15 times Y, and then after this, yeah, it becomes easy, guys. You can after this you can just group the like terms. Okay, firstly, you're gonna start by solving the bracket. So if you say 1 minus 0.2, you get 0.8. And then if you get 0.8, you multiply by 0.85, you're gonna get 0.68. Right? So this side is 0.68, and then it's gonna be 105 times the negative, so it's gonna be minus 105, and it's also gonna be minus. Okay, let me just do it. Oh no, wait, let me see. Yeah, let's just come, yeah. So you can see that I'm gonna solve the bracket first. This one is gonna be 0.8 times 0.85, gonna be 0.68. And then you're gonna say, oh, they also didn't show the step. But here it's gonna be minus 105 minus 0.15, right? And then you group the like terms, you're gonna get 1,160. And then you're gonna take these ones. Okay, when it's here. So this becomes 0.68, right? This, all of this. It's going to be 0.68, and then this will be minus 105 minus 0.15y. Right, then you group the like terms. So you're gonna get 160 plus. So if you say 0.65, 0.68 minus 0.5, 0.68 minus 0.15, I mean, you're getting 0.53. So it's going to be 0.53y. Okay, it's supposed to be y here. And then this is also y equals to. And then you're going to take this one to the other side. So it's going to be 1 minus 0.53. And then it's going to be 0.47. So 0.47y, 0.447y equals to, this is y, equals to 160, right? Then you're going to divide by 0.47 on both sides. So 160 divided by 0.47, and then you're going to get this 2,468. So what they did here, they just from this step they got 160, and then they just took um all the like terms to the left-hand side. They say y minus 0.68 plus 0.15, because it was negative here. So when you take it to the side, it's going to be it's negative. So if you take it to the side, it's going to be positive. Then if you say 1 minus 0.68 plus 0.14, you're going to get 0.47. Then divide by 0.47 on both sides. Here you're going to get 1, and the side you're going to get 2,468.09. right? And then they also said calculate equilibrium level of consumption, right? So they ask you to calculate the equilibrium level of consumption. So you know that the consumption function is given by C equal to C bar plus C, excuse me, plus C um Y. And then because this is not just any type of C, this is not any income, it's what disposable income. So it's given by YD, right? And you know that to get your disposable income, we can say Y minus T, or you can say 1 minus T times Y, right? And then so our autonomous consumption is given by, so we're given just the household expenditure, which is 215. So we're just gonna take it as it is. We're gonna say 215. Then we're gonna say plus C for MPC, which is 0.85. Maybe 0.85. And then we're going to also include the disposable income. So we're gonna say 1 minus T 0.2 times the income, because we calculated the income, we got 2,468 comma 09. This is 09 comma 09, right? Because they want us to calculate the equilibrium level of consumption, right? So they want us to calculate our C at equilibrium, right? So we just add all of this. Obviously, guys, you start with the bracket first, right? So it's going to be 1 minus 0.2. You're going to get 0.8. Then you're going to say 0.8 times 0.85. We're going to get 0.8 times 0.85. We're going to get 0.68. Then times 24 times that, and then times 2468,90. You're going to get 1,675,852. Then you're going to add 215. So 215 plus 1,678, 852. And then you're going to get 1,000. No, you say plus 215, you're going to get 1,893. Then they say calculate the multiplier. The multiplier is, you're gonna say 1 divided by 1 minus C is 0.85, so 0.85 into 1 minus T, which is 0.2, plus M, which is the marginal prosperity to import, which is your 0.15, this one. And then 0.15. And then firstly, you start by solving the bracket. And then I'm gonna write everything in my calculator. But when you're doing these questions, please, BODMAS rule, don't forget 0.2 plus 0.15. And then my multiplier is 2. So we're done. Okay, guys, that's it for chapter 18. Hope you guys did understand, and let me see. Yeah, it's 2.1. I hope you guys did understand, and I hope you guys all, I wish you guys all the best. Thank you guys for your support as well.